Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. We're here to give you the latest in real estate trends, mortgage updates, and regulatory changes that could affect your decisions in the Ontario housing market. In today's episode, we've got some exciting topics lined up, including a significant interest rate cut, insights on choosing between fixed and variable mortgage rates, and a spotlight on an extraordinary home in Burlington. Let's dive right in. First up, the Bank of Canada has announced a notable cut in its key interest rate, reducing it by half a percentage point to 3.75%. This move, which marks the fourth consecutive cut since June, is expected to provide some much-needed relief for homeowners with variable rate mortgages. The bank's governing council has indicated that their battle with inflation is nearing its end, signaling a potential stabilization in the financial landscape. This interest rate cut is particularly significant for those with variable rate mortgages, as it should help ease the financial burden on monthly payments. However, for those considering fixed-rate mortgages, the impact may be less pronounced. Fixed-rate mortgages are influenced by longer-term bond yields, which have already adjusted downward in anticipation of future rate cuts. The Bank of Canada also noted that the combination of lower interest rates and upcoming changes to mortgage rules set for December could potentially rejuvenate the current slow housing market sooner than anticipated. This could mean it's time for some prospective buyers to make their move as the competition begins to cool down. Speaking of the housing market, the Canadian Real Estate Association, along with economists and mortgage brokers, have observed that many potential homebuyers have been waiting on the sidelines longer than expected, hoping for mortgage rates to drop further. This has created a market where some buyers are now taking advantage of softer conditions, allowing them to submit offers with conditions on financing and home inspections. In an interesting trend, more Canadians are considering buying homes on their own. A survey conducted in July revealed that 42% of prospective first-time homebuyers are contemplating applying for a mortgage solo. This reflects a broader demographic shift in Canada, where single-person households have become the most common household type, making up 29% of all households as of 2021. Now let's talk about our home of the week. Nestled in Burlington, Ontario, this stunning property at 90 Oaklands Park Court offers a complete resort feel. Inspired by the luxurious Fairmont Pacific Rim Hotel in Vancouver, the home features two granite islands in the kitchen that cascade like a waterfall to the warm oak floors. The living room boasts a wall of book-matched marble, and the backyard is a private oasis with a saltwater infinity pool. It's a true retreat from the hustle and bustle of everyday life. And for those curious about the asking price of this beautiful property, it is listed at $5,288,800. It's a prime example of luxury living in a serene setting, perfect for those looking to invest in a unique and high-end home. Choosing between a fixed or variable mortgage rate is one of the most crucial decisions when buying a home in Ontario. This choice can have a substantial impact on your financial situation, particularly concerning the amount of interest you'll pay over the life of the mortgage and your monthly mortgage payments. With the Canadian mortgage market continuing to face fluctuations in interest rates throughout the year, it's essential to understand the available mortgage solutions. Let's break down the pros and cons of fixed and variable mortgages, their key differences, and help you determine which option best aligns with your financial goals and circumstances. So, what exactly is the difference between fixed and variable mortgage rates? Well, a fixed rate mortgage locks in your interest rate for the entire term of the mortgage. This means your monthly mortgage payments remain unchanged, regardless of fluctuations in home prices or interest rates. The stability offered by fixed rates makes budgeting easier and ensures financial predictability. On the other hand, variable rate mortgages feature an interest rate that changes with your lender's prime rate, which adjusts with each change to the Bank of Canada's overnight benchmark policy interest rate. Within variable rate mortgages, there are two types: adjustable rate mortgages and variable rate mortgages. An adjustable rate mortgage, or ARM, involves monthly payments that fluctuate with changes in the prime rate. If interest rates increase, your scheduled payments will rise. If rates decrease, your payments will fall. However, the remaining amortization period stays constant. In contrast, with a variable rate mortgage or VRM, your monthly payments remain fixed, but the portion that goes towards interest and principal shifts based on changes in interest rates. If rates rise, more of your payment goes toward interest. If rates fall, more goes toward paying off the principal. This can mean that the amortization period may change, as payments remain the same throughout the mortgage term. Now, let's explore the pros and cons of a fixed-rate mortgage. On the pros side, fixed rates offer predictability, as your mortgage payments remain the same throughout the term, regardless of any market changes. This stability protects you from potential rate hikes and makes it easier to budget, aiding in long-term planning. However, fixed-rate mortgages usually start with higher interest rates than variable ones, which can increase the overall cost of your mortgage. Additionally, breaking a fixed-rate mortgage before maturity can result in significant penalties, often calculated using the interest rate differential or 3 months interest, whichever is higher. Lastly, if interest rates decrease during your term, you won't benefit unless you refinance, which can also come with fees and penalties. Turning to variable rate mortgages, these offer potential cost savings, as historically, variable rates have been lower than fixed rates, leading to lower interest payments over the mortgage term, especially when rates are low. They also provide flexibility, as most lenders allow you to switch from a variable to a fixed rate without a penalty, giving you options if market conditions change. Moreover, if you need to break your mortgage early, variable rate mortgages generally come with lower penalties, typically limited to 3 months interest. However, they come with the con of unpredictable payments, as your principal and interest components can change based on the prime rate. Rising interest rates can significantly increase your interest carrying costs, slowing your ability to pay off the principal and extending your amortization. In terms of adjustable rate mortgages, these can offer immediate cost savings if interest rates drop, as your monthly payments decrease, providing instant savings. They are beneficial in a declining interest rate environment. Additionally, breaking an arm comes with lower penalties than breaking a fixed-rate mortgage. However, the unpredictability of rising interest rates can make it harder to plan finances, increase financial risk, and make long-term budgeting challenging, especially for first-time buyers or those with tighter budgets. Historically, variable rates have often been lower than fixed rates, making them an attractive option for homeowners looking to save on interest costs. From 2020 to early 2022, variable rate mortgages surged in popularity as low interest rates made them a cost-effective choice. However, as the Bank of Canada began raising interest rates in 2022 to combat inflation, the popularity of variable mortgages dropped significantly. By the end of 2023, fixed-rate mortgages accounted for most new mortgages. As we move into 2025, variable mortgages may regain popularity as interest rates are expected to decrease. It's essential, however, to closely monitor the market and consider your financial goals and risk tolerance before deciding. Fixed rates are influenced by bond yields, which are affected by economic factors such as inflation, unemployment, and market expectations for future interest rate changes. Typically, fixed mortgage rates are higher than variable rates, but offer the stability of consistent payments. Variable rates, on the other hand, are tied to the Bank of Canada's policy rate, which directly impacts the prime rate set by lenders. Changes in the policy rate can cause fluctuations in interest rates, affecting your monthly mortgage payments if you have an adjustable rate mortgage. In the case of a variable rate mortgage, your amortization may be impacted, meaning the time it takes to pay off your mortgage could change. When deciding between a fixed or variable mortgage in 2025, it largely depends on your financial situation, risk tolerance, mortgage rate forecast, and housing market predictions for the coming years. Similar to the Canadian housing market, mortgage rates are influenced by several factors, including inflation, economic growth, and changes in interest rates set by the Bank of Canada. The economic outlook for 2025 suggests that the Bank of Canada's benchmark policy rate will directly affect interest charged on variable mortgages. Many financial experts predict a gradual decrease in the central bank's policy interest rates throughout 2025, making variable and adjustable mortgages more attractive for homeowners willing to withstand some market volatility. If interest rates drop, those with variable rates could save on interest payments and pay down their principal more quickly. There's currently an almost 200 basis point, or 2%, difference between today's policy rate of 3.75% and the lower end of the Bank of Canada's expected neutral rate of 2.25%. Bond yields affect fixed rates, and Canadian bond yields typically follow United States Treasury yields, making American political and economic expectations paramount when considering a fixed mortgage in Canada. Both parties pose an inflationary risk in the upcoming United States election due to growing public debts, leading to higher fixed rates in Canada for years, even if inflationary pressures keep dropping north of the border. With closely tied economies, Canada imports most goods from the United States, meaning American inflation can also be imported alongside goods. Inflationary divergence puts pressure on the Canadian dollar's exchange rate against the United States dollar, making everything more expensive for Canadians to purchase. Increasing inflationary pressures could cause the Bank of Canada to increase its policy rate to stabilize our economy, which could cause variable and adjustable rates to increase. However, if you prefer stability and are concerned about potential rate increases, a fixed-rate mortgage may be better. Locking into a fixed rate will protect you from future rate hikes, offering predictable payments and financial peace of mind. For those unsure, a shorter-term fixed mortgage may offer the best of both worlds. You'll have stability for a few years, with the opportunity to renew at a lower rate if interest rates decline. Timing the market can be challenging, especially in periods of economic uncertainty. A key consideration when choosing between a fixed or variable mortgage is your long-term financial goals and ability to handle market volatility. If you anticipate a drop in interest rates, a variable mortgage could save you money in the long term. However, a fixed-rate mortgage may be a better fit if you prefer the certainty of stable fixed payments. Timing the Canadian mortgage market can often prove futile. Instead of focusing on market condition fluctuations, it's wiser to embrace an expertly crafted mortgage strategy that adopts a holistic approach, aligning with your long-term financial objectives and unique situation. For first-time home buyers, or those looking to purchase a home in a fluctuating market or during economic volatility, obtaining a mortgage pre-approval or pre-qualification from a mortgage broker or lender can help you lock in the best mortgage rates and navigate the complexities of the Toronto, Ontario, or Canadian real estate market. To effectively purchase or refinance a home or renew your mortgage, it's essential to resist the pull of short-lived market trends, clearly define your financial goals, and implement a long-term mortgage strategy. You can confidently compare mortgage rates in Canada by developing the right mindset, utilizing tools like a mortgage payment calculator to analyze your finances, and consulting with mortgage professionals and brokers. This method allows you to take advantage of opportunities while ensuring your long-term goals stay prioritized. Choosing the best mortgage rate is not a one-size-fits-all decision, and as our mortgage rate forecast will tell you, sometimes fixed and variable rates can diverge. The right choice depends on your financial situation, risk tolerance, outlook for the Canadian housing market, and mortgage rates in Canada. Variable rate mortgages offer flexibility and the potential for long-term savings, especially in a declining interest rate environment, but may come with a side of renewal payment shock if interest rates increase rapidly during your mortgage term. On the other hand, fixed-rate mortgages provide stability and protection from rate hikes, making them ideal for homeowners who prefer predictability. With interest rates expected to decrease in 2025, variable and adjustable mortgages may become a popular option again. However, before deciding, it's essential to review your financial situation and consider factors such as affordability, long-term goals, and market conditions. By partnering with mortgage experts, you can create a customized strategy for your home purchase, mortgage renewal, or refinance that aligns with your specific needs, risk tolerance, and long-term goals. These professionals will guide you through the mortgage process and the Canadian mortgage market, ensuring you make decisions that lead to a financially secure future. The Bank of Canada recently made its largest interest rate cut in over 4 years, slashing the rate by 50 basis points to 3.75%. This cut marks the fourth consecutive reduction, bringing the rate down by 1.25% since June. Despite this significant move, many experts, including Toronto-based mortgage broker Victor Tran, believe that further rate cuts are needed to truly ignite the mortgage and housing markets. According to Tran, the current interest rate environment still poses affordability challenges for many potential homebuyers. Even with the oversized cut, fixed rates remain in the low to mid 4% range, making home purchases unaffordable for many at today's prices. Tran emphasizes that rates need to fall further for buyers to confidently step off the sidelines. Looking ahead, there is optimism that rates will continue to decline, though the Bank of Canada seems to favor smaller 25 basis point cuts in the near future. With the next announcement set for December 11th, just before new mortgage accessibility rules come into effect, the end of the year could present a more favorable landscape for first-time buyers. One of the key changes coming in December is the increase of the insured mortgage cap to $1.5 million. This adjustment is expected to help many Canadians, particularly in high-priced markets like the Greater Toronto Area and Greater Vancouver Area, where freehold properties often exceed the $1 million mark. This change allows buyers to enter the market sooner without needing to save for a 20% down payment. Additionally, the extension of 30-year amortizations to all first-time buyers and those purchasing new-build properties is poised to enhance affordability further. However, Tran warns that the window for taking advantage of these changes may be narrow, as December typically sees a quieter market due to the holidays. As rates drop and new rules take effect, there is potential for increased demand, which could lead to higher prices as supply tightens. Tran advises those who can purchase now to do so, taking advantage of the current market conditions before competition intensifies in early 2025. For those ready to buy, acting now could mean avoiding bidding wars and securing a property before the anticipated rush. Tran suggests that waiting for further rate reductions or new mortgage rules might not be the best strategy if you have the means to enter the market today. The prime rate in Canada has experienced numerous shifts over the decades as the Bank of Canada has attempted to balance inflation control with economic growth. In the 1970s, the prime rate began to rise as inflation soared, peaking at 15% by the end of the decade. This was largely due to global economic factors like the oil crisis and adverse weather conditions affecting food prices. Moving into the 1980s, the prime rate saw even more dramatic increases, reaching a staggering 22.75% by August 1981. This was part of a global effort led by figures like Paul Volcker in the United States to tame runaway inflation. However, these high rates contributed to recessions in both 1980 and 1981 before the rate gradually decreased to 8.25% by March 1987. The 1990s brought a new approach with the Bank of Canada implementing inflation targeting, aiming to keep inflation between 1% and 3%. The prime rate peaked at 14.75% in 1990, but quickly fell as the economy weakened, never surpassing 10% for the remainder of the decade. This era marked a shift towards more stable economic management. As we moved into the 2000s, the prime rate peaked at 7.5% in 2000 before the events of September 11, 2001, led to rate cuts to stimulate the economy. The rates fell to 3.75% by early 2002 and remained relatively low throughout the early 2000s. However, the global financial crisis of 2008 prompted further cuts, dropping the prime rate to 2.25% in 2009. The 2010s saw a period of low interest rates as the economy slowly recovered from the financial crisis. The prime rate held at around 3% for much of the early decade, before two cuts in 2015 brought it down to 2.7%. By the end of the decade, the rate had risen slightly to 3.95%, reflecting a cautiously optimistic economic outlook. Entering the 2020s, the COVID-19 pandemic caused a significant economic slowdown, prompting the Bank of Canada to cut rates 3 times in March 2020, reducing the prime rate to 2.45%. As the economy recovered, inflation began to rise sharply, reaching 8.1% in mid-2022. This led to a series of aggressive rate hikes, bringing the prime rate to 6.45% by the end of 2022. Recent developments in 2024 have seen the Bank of Canada begin to ease rates again as inflation shows signs of stabilizing. By October 2024, the prime rate had fallen to 5.95%, following a series of cuts, with the bank leaving the possibility open for further reductions if economic conditions allow. This indicates a cautious approach to supporting economic growth while keeping inflation in check. As our final story today, we're turning our attention to Barrie, Ontario, where a new high-rise development is turning heads and redefining the city's skyline. This ambitious project, spearheaded by Barrie Waterfront Developments, is unlike anything the province has seen before, according to the developer, Gary Silverberg. The new residential tower stands along Dunlop Street West and is designed to catch the eye from every corner of the city. Silverberg describes the building as a unique architectural feat, with twists and turns that create an optical illusion, changing its appearance based on the viewer's perspective. This is not just another condominium, it's a landmark that promises to offer residents unparalleled views and a living experience that's a cut above the rest. Rising 33 stories high, this is the first of 2 towers planned for Barrie's downtown core, bringing nearly 500 new units to a city grappling with a housing shortage. The development is poised to transform Barrie's urban landscape, providing much-needed housing options while also acting as a catalyst for further urban development. Silverberg, a seasoned Toronto developer, was inspired by Barrie's waterfront and saw an opportunity to bring a new level of sophistication to the area. He believes that this development will set a new standard for luxury living in Barrie, attracting residents who might otherwise look to Toronto or other urban centers for such high-end accommodations. The building boasts a range of amenities, including an infinity pool, lounging areas, patio spaces, 4 floors of parking, and retail stores, all designed to cater to the needs and desires of its residents. The exterior of the building features colors that change with height, blending seamlessly with the sky to create a visually stunning effect. Silverberg envisions this tower as the first of many high-rises in Barrie, hoping to inspire other developers to pursue equally innovative and impactful projects. The first residents are expected to move in early next year, marking the beginning of a new era for Barrie's downtown. And with that, we conclude today's episode of the Ontario Mortgage and Real Estate Insights podcast. Thank you for joining me, Steve Hamoan, as we explored the latest developments in the Ontario real estate market. Stay informed, stay ahead, and until next time, take care.